birthday, Moses. So glad that you're having the opportunity to meet Mr. Richert. Mr. Rick Richert. And he is working with SoundPoint Capital, which is a $12 billion high-yield credit hedge fund based in New York. Everyone know what that means?
Yeah.
Good. Yeah, so I heard some of you guys in class were going to be really excited about his topic tonight, and I am too because I'm going to learn a whole lot, so I know that you will too. You've had his bio for a week now. What I wanted to share with you about him so I don't take too much of his time, he's been very successful, and I personally believe one of the reasons he's been so successful is he is doing what he loves. And so when I had the opportunity to visit with him for a while this evening, one of the things he shared with me when asking him, how did you get into this field? What brought you to Wall Street? And you've been successful there now for so many years. And he said, it was a class here at Southern. I took a finance class from a professor that used to be here. His name is Bill Richards. And he goes, and it changed my life. I knew right then that's what I wanted to do. And I just kept pursuing that and pursuing that. And he did it well. So he left Southern. He graduated in 1989. He then went to get his MBA at the University of Michigan at Ann Arbor, and has lived in New York City since he was 8, and has been working there. Did you work anywhere other than Wall Street?
I moved to California for 2 years and worked at MCA Records Finance Division. Just 2 years, then came back to New York.
So, a true New Yorker, and enjoy hearing about New York life. I think what we perceive it to be from a tourist perspective is much different than what life really is, and so it's kind of neat some of the things that he's able to do and enjoy. And he is married and has 2 kids. One of them has had the opportunity to play the piano in Carnegie Hall, and the other one I'm sure will be just as talented. And so please give a warm welcome to Mr. Rick Richert.
Well, I appreciate the invite. I'm very fortunate and grateful to be here. I really sat in your seats 28 years ago, and it's very nice to be back. I always think that Wall Street should have a few more Adventists. We close markets at 4 on Friday, and we're closed all day Saturday. So, anybody interested, please, email me after the presentation for sure. So what I was going to do today is talk, I manage CLOs and levered loans. So this is the biggest piece of my business, the collateralized loan obligation, and I figured I'd take you through this business tonight. So the agenda, click by click, okay, good. We'll go through 4 things only, but we'll spend a decent amount of time on some of the slides. What are leveraged loans? Then what is a CLO? Talk about a little bit about the CLO industry, and then questions. But please, I find it always best questions in between as well. We'll do questions at the end, but interrupt me anytime if you have any question whatsoever. So what is a leveraged loan? If you think about the capital structure of any company, this is what you have, right? These are the options. You have a revolver credit that can be super senior. It can also be pari passu or equal in ranking to the senior. You then have first lien debt, so that's a piece of debt that has the security of all the assets of the company, the hard assets of the company. So if the company defaults, you can take over the assets and recover your money. Other is a second lien, is similar to a first lien, but it's second in priority. So in a bankruptcy, the first lien gets out first. If there's excess collateral value, the second lien would get some residual value. The fourth structure of any capital structure of a company is unsecured debt. So it's risk reward is this spectrum, the lowest risk to the highest risk. Unsecured debt is just high yield bond market, unsecured bond market. And then you have your hybrid securities, preferred stock, and common equity. So that's any capital structure. That's all the options of a capital structure. Many companies only have say first lien debt and equity, but if you have deep capital structure, you can have all instruments in your capital structure. So an example, you might say, well, what the heck are you doing? This is a company that I would just show you an exact capital structure, and it's actually Ren and John. They had this on their marketing material as their front page. It's a great business because you're renting it, you're going to construction sites, golf sites. It's a really, really high margin, very nice business. So I thought I'd just show you one example of the capital structure. I did this financing in 2014. It was bought by a private equity firm, Calera Capital, a pretty small private equity firm, and they were putting in place this capital structure. You saw that they had no debt before. So this Calera Capital private equity was buying the whole company, putting in this debt, 175 million term loan, a delayed draw, which means that they're going to go out and consolidate the industry. The other nice thing about this business is it's a very fragmented business. It's usually mom and pop that owns some of these. This particular company, United Site Services, has a 15% US market share of this industry. So their motivation is to acquire, increase their EBITDA from 44 to 50 to 60 to 70. I think today this company is 90 million, and I did this financing in 2014, so it's been very rapid growth. So again, where I focus and what we're going to talk about mostly is that 175 instrument, and we'll talk a bit more about that in a second. This particular company had a subordinated bond in place as well, and the private equity firm put 163 million of their own money to buy the whole company. They borrowed the rest from effectively me and my competitors for the top of the capital structure. So just more, I'm going to click a couple of these. So if you just think about a leverage loan and some of the key features and uniqueness and attractiveness of a leverage loan, top of the capital structure. So even though we're trying to create very few defaults where we get things wrong and where they can't actually pay us back, we're always thinking about what is the asset coverage. If this does go bad, how can they pay me back? So that's a hugely important feature of the asset class. Floating rate is another very important concept. So anybody who's taken finance knows duration and knows the risk of owning a bond. Let's say you own a 10-year treasury bond. Rates go up 100 basis points. That note will go down 10% in value just from duration risk, right? So a really nice feature of a loan is it has 0.25 duration. And that's because it resets its coupon quarterly. So if the Fed, which is now raising interest rates slowly, continues to raise, you're going to get more and more coupon. So it's a very nice instrument. They can raise 200 basis points and the loan is not going to go down in value. You're actually getting a higher interest rate. So that's an important feature. Par callable by the issuer just means the company can, yes?
Could you tell me about coupon?
Yeah, so a coupon is just the rate that we are charging, in this example, United Site Service, for the riskiness we deem to be evident in the business model. So Apple, if I was giving Apple Computer a loan, I'd probably charge them 2%. They're not going to default. United Site Services, I believe the interest rate we applied was 6%. And it's all evaluating along the risk spectrum. A VC startup company, we'd probably charge 15%. Okay. So this is a...
You change that quarterly?
Yeah. And it's actually, it's a LIBOR spread concept. So I said 6%, but in reality it's LIBOR plus 500 basis points, or 5%. So as the Fed raises rates, LIBOR will go up. That 500 is constant. The LIBOR goes to 2%, now I'm getting 7%. So that is reset quarterly.
Okay.
Yep. Yes?
The acronym LIBOR, what is this?
London Interbank Offered Rate. Yep. It's just a global benchmark for short rates. Mm-hmm. So I was saying the par callable feature of the issuer is a very attractive feature from the company standpoint, because if you think about raising money, you want to have the most flexibility in your capital structure. So if they hit a home run and do really well, they can pay me back. So that's sort of a bad feature for me because I don't really want my money back. I want the 6% year after year. But it gives them a lot of flexibility. It's probably one of the biggest features from the company standpoint in wanting to issue a leverage loan. High recovery rates, I think I already did mention that, but specifically over the last 20 years, about 2% of these loans go bankrupt every year. And that's, ebbs and flows, but over the long term, it's 2%. 70 cents is typically what we'll get back. So a loss given default will only be 30 cents on the dollar when something does go bad. So it's a nice feature. That is in contrast to a bond. If a bond goes through bankruptcy, it's typically 40 cents back on your paper. So that's a good feature. Below investment grade, we don't play in the super safe, really good companies out there. The interest rate's just not high enough. It's not interesting enough. So investment grade companies typically finance themselves with high yield debt or investment grade debt, or equity predominantly. Big asset class, the leveraged loan. I don't know how many people knew leveraged loans before I'm speaking about it, but it's a $1 trillion asset class. It is somewhat young. If you go back 30 years ago, a JP Morgan would make a loan to a company to do this and would just keep it on their balance sheet. Like, I got the $1 billion loan, I like it, it's good. Today, and starting 25 years ago, there's a whole syndicated market that became, a tradable asset class. And now you can buy and sell these. A $1 trillion asset class probably is $2 billion, $2.3 billion trading every single day. I have a Bloomberg. I probably have 3,000 emails every day, and a lot of it is United Site Services is 99 by par or 96 by 97. Do you want to sell it at 96? You want to buy it at 97? So we can swap and constantly manage this pool of leveraged loans. Yeah.
You can handle that, 3,000 a day?
3,000 emails a day? It does cause me to not check my Yahoo very often. I'm very sick of emails. But it's not that I need to be focused on that. I have a trader. His focus is to look through all 3,000 and say, hey, Rick, I got this one that you need to consider. I'm also sort of looking at it. I have some screens, but I don't need to read all 3,000 for sure. Yeah. It's almost like a ticker tape in a sense, getting all those emails. So now we'll go to sort of the main part of the presentation. So that was the raw material, right? That what goes into a CLO. So I was just setting that up. So what is a CLO? It's a pretty busy slide, I apologize, but we'll go through this. So I am buying, on the left-hand side, this is a portfolio of about 120 different leveraged loans, all put together. Let's say that's $500 million, which is pretty typical for a CLO. I sit up on top, and my team, I have a team of 10 people, as an asset manager. We create a special purpose vehicle, right? So it's just creating a legal entity to serve one purpose, right? It just manages taxes. So we create this special purpose vehicle. That entity purchases the loans, but where does it get its money from, right? It gets its money by going to institutional investors, JP Morgan, Citibank, the government of Singapore. I mean, there's hundreds and hundreds of institutional investors, and we'll talk about the tranching, but we're selling about 90% of that collateral pool of $500 million, so $450 million of debt, right? So we're out there, and I'll talk in a second, we're saying, okay, JP Morgan, you want to own the super senior piece of this CLO? So how about I'll pay you LIBOR 120 or LIBOR 110? And we'll talk about how these are different risks, but as you go down that stack, it's going to be a higher and higher interest rate, right? It's down to the mezzanine, which is probably LIBOR 600, and then the equity finally gets 15 to 20% returns. Yes?
On the LIBOR scale, what's really low and what's like, oh my goodness, this is fantastic. Where am I missing?
So fantastic, yes, but fantastic in the sense that you're accepting a lot of risk to achieve fantastic, so remember that. LIBOR 200 is on the very low side. I'd say LIBOR 900 is about as kind of high as it gets. Yeah.
Can
Yes?
I clarify my understanding? So you guys
Yes.
And you're trying to attract people like JP Morgan to do what exactly?
So they have liabilities that they're trying to match fund, right? So they're looking for investments. It's really the treasurer of JP Morgan. He's got billions and billions and billions, close to trillions, but billions of dollars to invest. And he just kind of wants a cash substitute. So he's very interested for all sorts of reasons in this structure, and we'll get a little bit into it. This is a very granular pool with a lot of rules. Like, I would never be allowed to say, I'm going to buy $500 million worth of energy names, right? That would cause tremendous risk. So there's a lot of rules that create granularity, diversification, non-correlation within that asset pool that sets up a dividend stream that a JP Morgan is very interested in. And we'll get to, I think, what you're really asking in a couple of slides, why that's such a small risk up there, why he'd be interested in sort of that exact piece of paper. But he's just making an investment. He's taking his cash, he or she, and saying, I want to put $100 million into SoundPoint CLO number 12, and I want the AAA rated piece. So I know I'm going to get LIBOR 120, and I know there's very, very little chance I won't get my money back.
Oh, okay, yeah, because
Yeah.
there's collateral. Right?
Yes, correct. That's right. Yep.
Thank you.
Yeah, absolutely. So I think that's the bulk. Any other questions on this slide? No? Okay. And so portfolio characteristics. So this gets a little bit into sort of the rules on the collateral. Really important. Maximum 20% non-U.S. Domiciled issuers. Minimum 90%. That's probably the most important thing on the whole page. 90% first lien. I can't buy 40% bonds. I can't buy 20% second liens. It stays at a pretty low risk within the spectrum of leverage loans. I can do up to 10% second liens, 3% bridge loans, current pay, fixed rate, participations, DIP, which is debtor in possession loans. So a company goes bankrupt. It's probably one of the best loans in the world. A company goes bankrupt, needs liquidity to continue to operate. There's a loan that comes in that primes everybody, and you go to the very top, but you get paid sort of LIBOR 800, and there's almost no chance. I think there's been one DIP in the history of the world that's ever not gotten paid back. So it's a really nice piece of paper. 7.5% cap on that type of structure. Single obligor goes to the granularity, the diversification of the pool. So you have to have 2% or less, up to 5 exceptions of 2.5%. Again, that's so I don't go all in on food or all in on aerospace or all in on any particular idiosyncratic risk. Triple C, that's a rating. So that CAA1 is Moody's, triple C plus is S&P. I can't put in the lowest risk on the rating spectrum into the pool. Covenant light loans, that we can probably pass on that one. Revolving loans, deferred obligations. You kind of sort of get the gist. Also size. I can't make a $5 million loan to a company that has $1 million in profit. I mean, this is definitely bigger companies that go into these securitizations. Yes.
So all of these loans, somehow you have to split up the risk into those categories on the right-hand side of that slide. As far as risk, like how do you? Because some of these people that you're loaning money to a lot of people, correct? That's part of this.
Yeah, to a lot of companies.
Okay, so you're loaning money to a lot of companies. Some of them are going to default, or somehow you're not going to get some of your money back. How do you split up that risk among the different categories that you showed? Like, how does that get split up?
Next page.
Okay.
Next slide. Good question. Did you have something on this? Yeah.
Just a clarification, the percentages, what do those represent again?
So that is just percent of that $500 million that I've purchased as that big pool of assets across 120 different companies.
So
Yeah.
like the one that says like non-US dominant obligator.
Yeah.
This is 20%, so you own 20% of that company.
No. It means I can put in only up to 100 million of German headquartered companies or Zurich headquartered companies, non-US headquartered and operated companies. So 80% of everything I buy has to be a company that's headquartered in the United States. Yep. Yeah.
Is this like law like put in by the government, or is this within
No.
the company? Or?
No, this is it's really to create uncorrelated risk. You know, there's no way that the JP Morgan buying the AAA, there's actually no way that a rating agency would rate that top AAA if I were allowed to, like again, my previous example, buy 100% energy companies, like drilling companies. I mean, that went through a huge downturn, as we all know, 2014-15. The bank would see through that. You have too high a correlation in your collateral pool. So I don't believe you that it's a AAA rated risk up top. Because if oil goes to 26, which it did in February, I think 15 it bottomed, 26, 14 actually. I mean, I would have lost a ton of money, tremendous amount of money. So it's just creating that governor, which is really just put on by the investors effectively. It's JP Morgan's quant guys saying, this is kind of where I think the limits are, and then the industry sort of accepting that. Mm-hmm. Yep. Okay, so the next slide, the waterfall. So this is to your question, and this is really the rules that sort of create the tranching and segmentation of risk. And so what's happening here is, oh, there's a pointer on this, right? So, yeah. So that collateral pool, $500 million, paying 6%, is coming in. The very first thing that goes on with that pool of cash is I get paid my management fee. That's a small piece. I get paid 20 basis points up top, and all my competitors running these structures. And then if we make it all the way down to the bottom, I get another 30 basis points at the end. So the 20 is really a very highly protected management stream for me as an asset manager. This 30 is a little bit more at risk based on what's going on in the market. But the first thing is taxes, that 20% management fees, hedge payments, you know, if you're hedging out currency risk or anything like that, we usually don't do too many hedges. Hedges aren't really tremendously used. So effectively, it's a tiny skim off the pool of capital, and then you're paying the single A note, or the Class A note, which is the AAA, AA, and single A. So this is where the JP Morgan of the world is sitting with his $150 million invested in the AAA and saying, okay, here's your LIBOR plus 120 paid to you quarterly. If you then pass a test, which is, do you have 175% of the coverage of that obligation? Yes, you pass. So if you pass, you then pay off the next level of debt. You pay them, okay, you took more risk, your rate is LIBOR 300, here's your 4%, LIBOR 300. If you fail, so the reason you would fail is you've done a really poor job at selecting the United Site Services and the Assurion. I own Assurion. It's a $1.5 billion company that is the biggest insurer in the world of these around the whole planet. And if you do a bad job and you select the companies that aren't going to pay you back, which is the whole skill set that we have as a team, you're going to fail that test. If you fail that test, the AAA bond gets some of its principal back. So instead of JP Morgan owning $150 million, we're going to de-lever. We're going to take that cash flow and say, okay, I'm going to pay you down $5 million, which is a self-correcting mechanism. Because then that $150 million note that I owed the LIBOR 120 on is a $145 million note that I own 120 on. So I owe him less money. And so you would continue to do that until that's paid down enough and it's cured. Once it's cured, it goes to pay down the Class B note. So, and then you just go down the waterfall. Class B gets paid. You then test the Class B. Well, the Class B is set up to get paid. You run the test on the Class B being the triple B and double B tranche. So there's really 5 tranches of different risk in a debt structure of a CLO. If you pass that test, I get paid my management fee, my 30 basis points down below. If you don't, you pay down the AAA, but this is where the AAA is really protected. You will continue, if you continue to fail, and it's tested quarterly, you'll pay down the A until it's gone. And then only as you pay down the B to cure the Class B coverage test, will you get paid your management fee. Yeah.
So you're basically, if you don't have enough money to pay the people who bought Class B, then you have to instead pay back some of the principal for the Class A,
That's right.
so that you will then in the future owe them less interest.
Exactly.
But the Class B people still aren't going to get paid
No.
right then.
No.
It's just hopefully in the future.
Class B won't get paid until if you continue to fail. But see, that test is getting easier and easier to pass.
Because you keep paying.
Exactly. Right. So it would be a very rare situation where you would wind up having to pay off all of the Class A before the B gets paid again. It's just that ratio is going to improve enough where the B gets turned on again.
So for that time, you don't owe the Class B people anything, right? Like
Well,
do you have to eventually pay them all of what you?
For sure. Yeah. Everybody gets paid off at the end.
Even the interest?
Yeah. The debt gets all paid off. It's legally a 12-year structure. The way it works is typically the debt gets its money back in the 8th year. And that's because when you set these up, and I actually have it on the next slide, so we'll switch over real fast. We can go back to the other one. This is kind of the life cycle of a CLO. So day one, I got nothing, but I create this special purpose vehicle that starts buying collateral of companies. So I ramp up how much I'm invested until I close the deal, ramp it fully, and then for 4 or 5 years, I can buy and sell. And that's where the real skill of the manager comes into play. Selling things at 102, buying them at 90, which something's gone wrong for it to trade at 90. So it's all the assessment of, is it a temporary thing? Can they fix it? What's happening is it a cyclical issue? Is it a secular issue? We own very little retail because Amazon is killing all retail. That's secular. I like to run away from that risk as fast as I can. So it's all about that management of up and down. But after 5 years, it then closes. So I can do nothing any longer. Hopefully I have a good collateral pool in that 5th year, and it will start to pay down. So instead of the cash flow reinvesting into assets, it pays off the AAA, and it goes all the way down. I have one CLO that used to be $500 million is now $200 million because it's just paid down the debt. So that's what happens at the end. Yes?
So you're paying interest all along, and then at the end, where the risk comes in is that they may or may not get paid back their principal? Is that how that?
If the collateral pool is still very healthy companies, they're never going to be at risk, no matter where you are in the life cycle. So they're at risk not because of the timing. This is just the unwind. It's not a permanent vehicle, right? It's a 12-year life. So we have to be done after 12 years, right? It just works effectively because the assets are so prepayable. Once I can no longer invest, I have about a 20% prepayment rate of companies like, I got too much cash, I'm not going to pay LIBOR plus 600 anymore, I'm going to give you my money, I'm going to pay off. So it starts to naturally amortize down and get paid off because there's that natural 20% prepayment rate. So it's not that it's at the debt holders are not at any particular risk at the end due to the structure. They're always at risk based on the quality of the collateral pool. Yep. Oh, you had a question? Sorry. Yeah.
I was just wondering, has there ever been a situation where the life, you're supposed to be done with this, the CLO life cycle, but for some reason it just is that a possibility where things go wrong and you can't end it?
Not where it goes wrong. Not where you can't. Yeah. Yeah. So if you're doing such a bad job at paying of managing the collateral, you're picking the wrong company. buying things at 90 that go to 60, all that kind of stuff. The structure will actually, because you're going to hit so many of those fail levels of tests, the debt is going to get paid off a lot faster. So that's actually bad from the debt perspective, because if I'm the treasurer of JP Morgan, what I'm really trying to do is create a duration certainty match. I have certain liabilities as JP Morgan, maybe bank deposits or whatever it is. I feel my liability structure is 3 years to the month. So I want to buy a 3-year asset to sort of defease and match fund that. So it's not necessarily good, but that's what would happen. Is it would not stay out forever. It would actually stay out for less of an amount of time because you'd be paying down the structure. Yeah.
Where do you get most of your information about what to buy and when to buy it?
That's a big answer. Wall Street kind of prepares books. So United Site Service, I think it was a Goldman Sachs deal. They have a bunch of bankers that do some of the initial work, send a book, 70-page book to me. We do a lot of research outside of that. I jokingly say when I hire a new person, I've never seen a risk in any of those books ever in my life. So it's a bit of a marketing document from Wall Street. But we have direct relationships with the CFOs. We do expert network calls. Ex-CEOs, COOs are part of this network where you pay, I think it's $1,000 for an hour, so it's pretty expensive. But when it's a really dicey company, we talk to our competitors. We read sell-side research. I run the business where I have an energy analyst. I have a healthcare analyst. So it's a vertical structure set up. So I expect my healthcare guy to know everything about healthcare. He spends his whole time understanding, the ACA, nobody knows exactly what's going to happen, but he spends all of his brain cell, yeah, exactly. He spends all of his time analyzing that. So when I have a healthcare company, it's him leading the deal discussion where a group of people 10 people sit around a room and just debate the risks of it. So it's a very in-depth process.
You have to bid on that, right?
Say it again?
Like if you're going to buy that debt, you have to bid on it?
Well, so yes, in the secondary market. So once it's initially syndicated, the Goldman Sachs will sort of set the first price. So Goldman made $1 billion loan to a healthcare company. I'm going to sell it at 99 cents. That's the initial. But from then, yes, absolutely. It's trading out in the market. It's on my 3,000 emails on Bloomberg. And we decide, if I want to outbid a guy, I can outbid a guy. If I want to backbid a guy, I can backbid, sit there at 96 when it's trading at 97 because I think something's going to happen. It's going to fall. Yeah. Yes?
So, sorry, I still don't totally understand the risk. So, if everybody gets paid back?
Yep.
What is the risk of getting one of the classes that pays more interest?
Okay, so if you think about the defaults are going to not harm the top of this waterfall structure, right? Because if a company defaults, the single A is going to get paid almost. You have to have a tremendous number of defaults. It's the layer. Let me show you this here. This on the right-hand side, the super senior is where the AAA, AA, and single A sit. You have to have losses that eat into the collateral that goes from the bottom up, right? The equity takes the first loss. The junior debt takes the next level of losses. So you have actually 35% subordination to the AAA. So AAA, there's never been in history, the CLO market's only about 22 years old, but never in history has a AAA ever not got their money back. Yep.
But it would be possible if I was, say, if I was a bank manager and I bought some mezzanine, it would be possible if things go south for you, for me to not get my principal back?
Yeah, for sure,
Okay.
and has happened.
Okay.
Yeah, the double B has absolutely been impaired, is what we would call it. Triple Bs have been impaired, even single As. That's as high as any impairment has ever occurred in history. Not to say that history is absolutely going to represent the future, right? It could change,
So if
but
you
historically.
So if you keep failing and you have to like reduce the principal on your class A or whatever, but eventually, by the end of everything, do you still owe me the interest that you didn't pay me when you were failing?
Yes, yes.
So in what event would you not pay me that interest?
If the collateral pool defaulted to such a level where I just don't have the cash anymore, right? It's a special purpose vehicle. There's no extra money. There's no recourse to anybody. They can't come after me or my kid, But that is part of the reason for that special purpose vehicle, right? It's a contained risk. Yeah, it's a contained risk. Yeah. No, I mean it's everybody's a big boy. Guys that are looking to make LIBOR 800 certainly know they're not taking treasury risk. You take treasury risk, you're going to get 50 bips, right? So it's all about that. So
What would be the chance that someone in the junior mezzanine would get everything that they thought they were going to get? Like what would roughly be the odds?
I would say historically 85, 88% that they'll get their money back. It's actually a pretty good structure. Yes, you had a question?
How many of those CLO life cycles are you going through at once?
Good question. We do 3 a year. We're now managing 14 deals. And I only have 1 that's starting to deleverage. So it's sort of, I think as a natural thing, I'll probably be running 20, 22. And it'll sort of, they'll delever and I'll put on new ones and it'll stay around 22. Yeah. Yes?
Just to make sure I fully understand, I've been taking finance ed, so
Yep.
a little bit of a learning gap here, but with the CLO, that would be like a group of loans, right? And like if someone invests in a CLO, they're investing in the idea that the people who loans have been grouped together into the CLO will pay back those loans. Is that how it works, or?
Yeah, absolutely.
So let's say I own a company and you own a company, let's say 5 other people own a company.
Yeah.
And we all take the loans out. Could all those loans be grouped together as a CLO?
Sure.
And then let's say my friend invests in the CLO, a certain percentage of that CLO. He would only make money off that CLO under the assumption that enough of us pay back our respective loans, so that way the CLO becomes profitable.
Yeah, I mean, pays interest. It's actually about paying interest along the way that drives economics primarily. Certainly it's important to pay back as well. Typically companies like United Site Services doesn't, sort of get towards the end. These are 7-year length maturities, these leverage loans. Typically doesn't get to the end, the 6th or 7th year and say, here's the money back. They go out and refinance it. So they'll say, okay, I'm going to go out for another 7-year deal. But yeah, effectively the ability to pay the interest or the ability to refinance, which means you have to be a healthy company. Nobody's going to refinance you if you're headed towards bankruptcy. Yeah. Yeah. Any other questions? No? Okay. Let's see. Okay. Yes, I think that. Any other questions on the structure? No? Okay. Let's see. I have a keyboard over here. Yep. Okay. Why manage? What's the point of all this, right? Why do it? What's the big deal? Actually, the technology has created, and this obviously for people in finance, this is sort of a capital market line, has created the equity tranche. So the guys that own that equity slice as taking the maximum risk, the manager or the market is going to do so well. Sometimes if the market does so well, it doesn't matter who the manager is. But if things are set up in such a great benign way, or you have great managers, all the debt's going to get paid, every penny, all the time, and you're going to have money left over, right? You just think about the math. I've bought this special purpose vehicle, has bought $500 million of interest-bearing instruments, but we've only raised $450 million of debt. So there's a positive arbitrage, right? All we're doing is, it's a cash flow arbitrage. You're getting 6% here. You're raising debt, but you're paying effectively sort of 3%, and you're making that spread. As long as you can manage and stay in the right companies, that spread will continue. So if you look at the residual or the equity piece, the one that says, oh, there's money left, we're going to give it to you, the equity, it's typically lines up very well. Treasuries, lowest risk, government's likely, not going to default, maybe forever. We'll see. And you're getting, on 10-year Treasury, I think today is 250, right? So you're getting 250. You go up the risk spectrum and the return spectrum of asset classes, investment-grade corporates, high-yield corporates, S&P 500, emerging market equities, mezzanine securities, which is really just the lowest part of debt in companies, and then CLOs. Private equity is the top. That's the guys that I talk about buy the United Site Services. They try to improve the companies, make acquisitions, grow it, and then sell it again. That's probably the best return out there in the world. And that's sort of 25 to 30% with risk, but still a really good profile. CLO equity typically is 18 to 20% returns. I apologize, I stole this from my marketing team, so it's a little bit of a plug for my company, but we can ignore that part. This is really just meant to be the capital market line and just risk reward. And so that's why managers are sort of managing these structures. Yes?
So how is it out of line with everything else? Like, it looks, if I'm reading this right, it looks like it has a much higher return potential for the risk level.
You're talking about the SoundPoint CLO equity dot?
Everything else is perfectly on the line.
Right. That's just because my marketing guys put it together. No, I'm just kidding. No, I'm kidding. So what we're doing is our management philosophy is to not care about, so Heinz was in the market. Warren Buffett bought Heinz, and I don't care at all about Heinz. Like, Heinz will never default. I think we'll eat ketchup forever, and my kids and my grandkids and my great. So who cares about Heinz? Like, it paid me LIBOR 200. I could care less. So we're not doing the Heinzes, not doing all the big, and those are called flow names. I mean, the big Fidelities buy those and so forth. So we're not doing that, and then we're also careful not to do the middle market clubbed up deal where 6 guys own the loan, because we're always thinking, look, we're going to get something wrong, right? If I get something wrong, I need to be able to sell it. I can't sell something that 5 people own. I need like 20, 30, 40 people to own something. So it's our management style that has created a higher, instead of 6% for the industry, we're typically getting sort of 675. And since these structures are 10 times levered, it's really, it amplifies that extra yield. So that's why we're sort of over there. But our default experience is actually less than the market. Yep.
So if it really is as glorious as it looks, why doesn't everybody buy those instead of, because I mean, I don't know if people buy mezzanine and EM equities and US equities and all that other stuff, but why doesn't everybody just go buy SoundPoint CLO equity?
In 2015, SoundPoint CLO equity lost 11%. The market lost 18%. And that's because we had a head fake in oil. People got way too bullish. People chased that rally until, I think, May 15. And then everything imploded. Everything went back down. And the fourth quarter of 15 was brutal. People were losing money left and right. So not everybody has that profile. Some people don't want to ever lose money. It's a free world, right? You can choose that. So you would never be up here. I mean, if you're a treasury department of a big company, you're probably playing in investment grade corporates, treasuries, and maybe just a little bit high yield corporate. Yeah.
But I guess what I'm saying is, like, compared to people who would choose something else at the same risk level, why are you? Because it seems like if this is
Well,
really true, you have a better product than everyone
Yeah,
So why
not
doesn't everyone go and buy it?
not to be immodest, but we're the third best in the world. So people are. Everybody is. So I guess that's the easiest way to say it. Sorry. We'll get back to that. But you nailed it. But yeah,
I just feel like if something is that good,
Yeah.
it will suddenly, like because of supply and demand, if something is that good, people will go out and buy it, and
Yeah.
then it will go up in price or something. Like there's no way for something to be magically wonderful
Yeah.
for everyone to know about it.
Well, so that's efficient markets, and I totally agree with that. And I'm not naive by any means. I do think we're going to get pressured as a manager because we're in an advantage of being 8 billion in size. So I can be very selective. I can say this company that Goldman Sachs is showing me is junk. There's no way I would buy that. When I become, and my firm becomes 30 billion and 40 billion, the math just doesn't allow for the same level of selectivity. So you have nailed it. I think there is going to be pressure. Nothing can be here forever. There'll be a migration. I'm enjoying my 15 minutes of fame now, being here. But yes, as we get bigger, we're going to sort of have to buy, not necessarily Heinz, that's an extreme, but pull back Heinz on something that's less yieldy, giving me less return. I'm probably going to be forced to marginally buy that because I just have to run a $20 billion machine, not an $8 billion machine. So yeah, there will be pressure.
So the bigger you get, the worse you're going to get. Pretty soon you're just
To some degree.
somebody else.
Yeah, isolated, all else equal, that is a truth. Yeah, yep, yep. You had a question?
Yes, I was just wondering, you said size might hinder you with your returns. Would you ever consider downsizing in that case?
No.
Don't some hedge fund
Not downsizing, so
returning the assets?
not quite. We do have a policy. We haven't hit it yet, but we're actually approaching pretty close on one part of the business. And it's really just running loans with no structure on top. Right? It's just, I'll give an investor 6% return, right? And have a floating rate, coupons will go up, they'll go down. That we say we're going to close at $4 billion. And we're at, I think, 2.7 billion. And it's exactly for that reason. Like, we don't want that fund to be 10 billion because I don't want to buy Heinz. Nothing bad about Heinz. It's just a no-brainer. There's no risk whatsoever. So I am going to cap that at 4 billion. Is this recorded? No, I'm kidding. I'm going to cap that at 4 billion, and it's to stay because our culture is we do like to sort of be really good. We don't necessarily need to be the biggest. So yeah. But it's not going from 2.8 down. That would be tough. Okay. Let's see. So a little bit more about the CLO industry. Yeah, go ahead.
Can I just ask one more?
Of course.
So basically what you're saying is that you're going to run out of really good companies to buy if you have to buy more companies to make more money? Is that there's only so many?
Good is the word you're using. I would just say it's the profile of what I like to buy. So I like to get overpaid for the risk I'm taking, right? So I think there's only so many of those. Correct. That's right. Yeah. So this just shows a quick snapshot of the CLO industry and the issuance per year, all the way back to 1999. These are in billions, so 14 billion. Then it went into a massive bull market, 2007. Then the Great Recession of 2008, where the world almost ended. And nobody issued any deals in 2009. 10, 11 was a tiny revival. We started this part of our business in early 2012. So that's where we first started, and it's revived quite a bit. Not too important, but one of the main reasons it's tailing off recently is there's a regulatory rule that says you have to be, the manager has to own 5% of the deal structure themselves. So it's a skin in the game. is sort of around CMBS. You know, the big implosion in 2008 was in part CMBS. Even though there's tremendous differences between CLO and CMBS, the regulators have put that in place, so it's a little bit more difficult to issue these today. Yep. So these are the managers around the world that manage CLOs. Credit Suisse is the biggest in the world. GSO Blackstone. Blackstone is a private equity firm. Carlyle, I think probably a lot of people do know a lot of these names. Apollo is a big private equity firm. Octagon, and we're down 16. So this is a little bit old. I think we do have 14 deals now. I think we're $8 billion. But you'll see a little bit better representation of the whole industry. Yeah, it's kind of consolidated. Top 50 run 74% of all CLOs, and it's, you know, it tails off quite a bit. There's 150 CLO managers in the world, soon to be less, because not everybody's going to be able to meet this regulation. Not everybody has that 5% to own. So I would expect in 5 years, probably there's 70 managers in the world, down from 150. And then this was a little bit of a shameless plug, but this is a Wells Fargo report, and these indicators are what the Wells Fargo research analyst deems to be the 10 most important criteria in evaluating a CLO manager. And so this report truncates down to the top 65 managers in the world, and we're number 3. He does this monthly, so we've sort of gone up and down. We've been number 1, we've gone as low as number 8. Most recently, we're number 3. So I think that was it. So, yeah. Any other? Yeah.
Yeah, when that kind of report gets published, what's the immediate effect for you and your company?
Quite good. I say, yeah, it's quite good, yeah. He's my best marketing guy, and I don't pay him any salary. Yeah, we were quite pleased with that report, and it's really interesting. He started to come out with it 2 years ago, and we were rated number 2, and some of the very big brands were sort of rated, 29th, and I think some of those managers, I probably shouldn't say this, but I think some of those managers are now running to that report to try to move up, the ranking. But I was in Tokyo in November, so Japan is pretty unique in the sense that they won't really give money to a manager that's on their first or second deal. That's kind of their profile. Now that we're on our 15th, we think Asia is a great place to brand. And so I was in Tokyo and Seoul, and in Tokyo, a lot of them, there was no interpreter needed. This person spoke very little English, but he said, "Oh yeah, Wells Fargo report. How do you do that?" So it's great. It's a globally recognized sort of ranking from a strategist. It's been pretty helpful. Yeah. Yeah.
As a Seventh-day Adventist, how does it affect you working in Wall Street? If you don't work on Sabbath and Friday and sunset, how does that affect your performance? Or what do you do to?
No, you maybe missed my lead in. I think it's a great industry because markets shut down 4 o'clock on Friday, stay closed on Saturday. So there's really no effect at all. I mean, I am in the office sometimes on Sunday, but not often. I guess maybe more when I was younger. Now I make people go in on Sunday. But there's no effect whatsoever. I mean, I have a very strong work ethic. I get stuff done. Sometimes I stay till, I'm happy to admit I'm 51. I have no problem because I think it's successful if I become 52 and then 53. That's huge success. I hope I make it to 99. But I'm sort of a 51-year-old working like a 28-year-old. I work really, really hard. So hopefully I'll slow down one day. Yep.
When you first started in the industry, you were talking about the Sabbath issues, and you were lower down the totem pole. Did you have Sabbath issues then?
No, I didn't. No. I think I'm on the buy side. So if you think about Wall Street in a big go to 50,000 level, there's kind of two sides, right? There's the traditional Goldman Sachs investment bankers, Credit Suisse investment bankers that have the the relationship with the company, putting together the financing. That's never appealed to me tremendously. I have a lot of respect for the people that do that, but to me, it's less than 100% objective, right? Because they're doing it in part to get the fee, the investment banking fee. It's great. It's a great for certain people. For a lot of people, it's really great. I've always been on the buy side, managing money. And so one thing that's helped me is I don't have to be in there I've never been asked to be in there on Saturday because we have something that is due on Monday. So I guess I'm lucky in that sense. I wouldn't have gone in on Saturday, and I don't think it would have hurt me. But I've particularly been in sort of a little bit of an advantage in that respect. But I think Wall Street is not like the 80s anymore. People respect all sorts of different views. And so if you're on the sell side, if you want to be a Goldman Sachs investment banker, which can be an amazingly good career, I think there's a balance out there in the world. You strongly go in and say, I'm done Friday night and I'll come in Saturday night. I think 98% of people are going to be absolutely cool with that. Yeah.
Can you tell us more about your story on how you fell in love with this and how you knew it was right for you? What did your teacher say when you teach?
Yeah. So I have.
Add on to that.
Yeah.
When you were here and had that experience that she's talking about.
Yeah.
How were you prepared to go into such a competitive industry when you went to Southern when there were 1,500 people in a no-name Christian college in the middle of Happy Valley?
Yeah. So my father went here as well. He was an English professor, and then and that was his love, literature and poetry and just words, right? That was his real love. He started to write a business paper in Texas. The Wall Street Journal saw his stuff, and that's how my family went from the South to the North. They hired him up. He was the Wall Street Journal bond columnist in the 70s. So.
Also, he got to make their numbers look pretty.
Well, no, he wrote on, GE's going to do $1 billion deal. He was a syndicate person. So that exposed me to Wall Street, and I sort of liked the competitiveness and so forth. I started freshman here thinking I was going to be a mechanical engineer. I liked math. I liked to figure stuff out, although I kind of call a lot of people to help me out now. But I liked math, so quantitative was always going to be a piece of my career. And I took Finance 101 from Bill Richards. He was super demanding, great, just brilliant, knew so much, and I just loved the subject matter, and I loved the challenge and the level he challenged me. And I just like to rise up to that, right? So I think extra demanding just makes you better and better. And so that, led to CPA. I knew that would be I was a Pricewaterhouse auditor for 2 years, got my CPA, but I always knew it was on the way to finance. And then got my MBA in finance, so further studied finance, and then went to managing money. Yeah. Sort of, I have an uncle who used to run the math department who's sitting here, who understands math at, 100th higher than I do. So this was sort of a combination of light math and money, so that was perfect for me. But seriously, I just loved the subject matter. Yeah. And the teacher was very challenging.
Do you think you would have been less happy if you ended up an engineer?
No. That's a thing that I'll equate that question to sometimes when people ask me, don't you need to get your kid into this private school in Manhattan because that's really the greatest path to Harvard Business School? I'm like, no, there's 10,000 paths to Harvard Business School. And there's 10,000 paths to happiness, right? I mean, there's so many branches that you're going to take in your life. You just have to make the right ones all the way. Yeah. Any other questions? No? Okay, thank you. Go ahead. Sorry.
Quick question.
Yeah.
A lot of people who I see do very well in business and whatever they do, it often comes at the cost of family. And as someone who's been so successful, what are some things that you attribute your success to with your family, or you've been successful that
I don't quite skip my phone into the ocean like the commercial, but I, I do try to work hard and play hard. So I also have a routine. I walk my son and daughter, 10 and 7 years old. I'm normal in New York. I'm an old father down here, but I'm a normal guy in Manhattan. I walk my 10 and 7-year-old 6 blocks south to his school. He's in 4th grade, then my daughter to 1st grade. So I get that bonding. I make sure, I mean, family's the number one thing in the world, period. And everybody will know that. When you're single and young, you don't always understand that. The second you have a kid, you'll know it for sure. And it's just making those moments, you know, you can balance things, right? If you just make yourself balance things. So I determine that it's very important, and I make time for the kids for sure.
And your work doesn't get in the way of that at all?
So I would imagine my son would like me to be home at 6 more often. So, you know, maybe it gets in the way a tiny bit. He's super happy, he still likes me. So, you know, I get home at 7:30 a lot, but it's not a deal breaker. So, yeah. So thank you guys. Thanks.